All right, I hope you're ready for some appendix fun. We're going to talk about cost behavior and analyzing mixed cost a little bit more. Remember, mixed costs are the costs that we talked about that are a combination of fixed and variable costs. This kind of looks like that break-even graph that we talked about as well. All I got to do is put in my sales, and there's break-even right there. So our mixed cost is a combination of variable and fixed costs. We want to be able to accurately predict costs at various levels of activity, and in order to do that, we need to be able to break down our mixed costs into their fixed and variable components. That's also necessary in order for CVP analysis, what we learned in the main body of Chapter 5, to work. So how are we going to do it? Well, remember that we can define our mixed cost as y equals Vx plus F. The book calls it like A plus Bx or something, but I like Vx plus F, where V is the variable cost per unit, X is the number of units, and F is my total fixed cost. So when we have mixed costs, the way we're going to break them up into its variable and fixed components is to use various methods to distinguish between the two types of costs. In account analysis, each account is classified as either variable or fixed based on the analyst's knowledge of how the cost behaves. An engineering approach, on the other hand, classifies costs based upon an industrial engineer's evaluation of production methods, material, labor, and overhead requirements. For our purposes, we're going to analyze mixed cost using either a scatter graph plot or the high-low method. The scatter graph plot is what I would call the half-ass method, which is basically plotting all the data points on a graph and then drawing the line using your eye to determine the best fit. There's no way I can test you on that because everybody would draw a slightly different line, so you just need to understand from a conceptual frame point what scatter graph plot method would be, and then we're going to focus on high-low and regression methods. So here's a bunch of data points. Hours of maintenance would be our X variable, and then our total cost would be Y. So if we plot those dots on a graph, then we can see there is some linear relationship here, but the question is, how do I draw my line? Is that the best fitting line? Is that the best fitting line? Is this the best fitting line? Which line is the best indicator of the cost structure demonstrated by these various dots? The answer is I don't know. There's no definitive way to determine that by just using our eye and drawing some type of line through them, which is why this isn't the best method. It is a useful method in that if we are able to draw a line, then we can come up with the cost equation y equals A plus Bx, which again I replace A with F and B with V because it helps me remember what the variables stand for. So once we figure out what that line is, that best fitting line, we'll be able to then distinguish between fixed and variable costs by using this cost equation. So the goal is to figure out what line to use in order to define the equation, and once I define the equation, then I'll know what my fixed costs are and what my variable costs are. That in turn will allow me to use CVP analysis and also allow me to predict my costs at varying levels of activity. Using that formula, I can then predict cost at any level of activity. So if my monthly utility charge is $40 and my variable cost is 3 cents a kilowatt hour, I think we did this back in Chapter 1, and I want to know what my cost would be when I'm using 2,000 kilowatt hours, I just use my formula, y equals F plus Vx. F is my fixed cost, which is the $40 monthly cost. V is my variable cost per unit, which is 3 cents. And then my X is my 2,000 actual kilowatt hours used. Do out your math. This represents total variable cost. This is my total fixed cost. and the 100 then is my total mixed cost. So by breaking out total cost into its fixed and variable components, we're able to use this formula to predict cost at any level of activity. That's the overall goal of all of this. So what we're going to learn how to do is the high-low method, which is a definitive way that will allow us all to get to the same answer for what our cost formula should be. With the high-low method, we choose our high and low data point based on activity. So our low data point based on activity is 450, and our high data point is the 850, and then we use the corresponding maintenance cost that goes with each one. So to determine the high-low data point, you use effectively your X, and then you pick the corresponding Y to make up your data points. Then the first step is to get your variable cost per unit, which is your high cost minus your low cost divided by your high units minus your low units. So the example here, my high cost is 9,800, my low is 7,400, the difference is 2,400, that's my numerator. And then for units, my high is 850, my low is 450, so the difference is 400, that's my denominator. That now gives me my variable cost per unit, which is $6. Then what I have to do is I enter that $6 per unit in for my cost formula for V. So Y equals Vx plus F. Y equals 6x plus F. And then I can choose my high or low data point in order to solve for F. They're going to use the high in the textbook answer, so I'm going to use the low in mine. So the low total cost was 7,400, and then the X was 450. So if I do out my math, 450 times 6 is 2,700 plus F equals 7,400. And 7,400 minus 2,700 gives me F equal to 4,700. They reformatted the cost equation to solve for fixed costs. I don't recommend you do that. It's another equation to learn. I don't see the point. But either way, whether you use the high data point or the low data point, whether you use this formula or my original Y equals Vx plus F, you end up getting your total fixed cost equal to 4,700. What that allows me to do is come up with a cost equation for the mixed cost line, which is Y equals 6x plus 4,700. And that in turn allows me to predict cost at any level of activity. It also allows me to do CVP analysis because I've broken up my fixed versus my variable components. So I can create a contribution margin income statement with that information. So again, there's our overall cost formula, Y equals 4,700 plus 6x. We can put in X for any level of activity and predict what the total cost for maintenance would be. This isn't a perfect method because it is based on a bunch of data points. And depending on where your high or your low data points turn out, it could either work out really good or really poorly. So this would be my low over here, and then my highs over here. So I don't know if that's the best fitting line or not, but that's the line we get with the high-low method. We're basically figuring out the cost equation for a line that goes through the lowest and the highest data point. Looks like all these dots are kind of left out of the equation when we do it this way. So it really kind of depends on where those dots end up being, the high and the low dot, to determine, you know, maybe that would have been a better line to determine how accurate this is. So it's not the best method, but it's quick, it's easy, and it is a method that'll allow us all to arrive at the same conclusion. So let's do a little quick check action, see if you learned anything. So pause it and give it a go, and then we'll get back together and do it. All right, welcome back. I know some of you didn't pause it. Shame on you. So sales salaries and commissions are 10,000 when 80,000 units are sold, 14 when 120 units are sold using high-low. Let's figure out the variable portion. So to do the high-low method, V is going to be the high cost minus the low cost over the high units minus the low units. So the high cost is 14,000. The low is 10. The high units are 120. And the low is 80. So that gives me 4,000 over 40,000, which with my limited math skills, and they are limited, I believe comes out to 10 cents. And there's the short calculation. The difference in dollars is 4,000. The difference in units is 40,000. And indeed it is 10 cents. Now we have the same information. We want to get the fixed part. So we know y equals 0.1 x plus f. Use the high or the low. I'll use the low. The low cost is 10,000. The low units is 80,000. So that gives me 8,000 plus F equals 10,000. So F equals 2,000. So the answer should be A. They calculated it out and got the same 2,000. It looks like they used the high data points, whereas I used the low, and you can see it didn't matter. We got the same answer. The reason that works is, remember, we're trying to get a cost equation for the line that goes through both data points. So whether you use the high or the low data point, you're going to arrive at the same conclusion. So when all is said and done, y equals 0.1 x plus 2,000 would be my cost formula for this line. The better method of doing this would be to use Excel and use the sum of least squares regression. Good news, we're not going to have you do that. Bad news, you're at least going to need to know what it's all about. So using the least squares regression method puts the data points in and then statistically determines what the best fitting line is, basically minimizing the distance between each data point and that line. It's a far better method because it uses all the data points to estimate the fixed and variable cost components as opposed to just 2 data points that the high-low method uses. You won't have to figure out how to calculate it in Excel, but when it's done, this is the output that is going to be provided. If you're given this output on an exam or quiz, you need to identify the items in orange. R squared tells us how good of a fit our line is. 1 is the best for R squared. 1 means every single dot is on the line. So 0.94 is 94% fit. That is really, really good. Usually 80% or above is considered a good linear relationship. And then the other orange items you need to be aware of are the intercept and the x variable. The intercept is our F, our fixed cost, and the variable would be our V, our variable cost per unit. So given this information, I can very quickly and easily determine my cost line. Y equals 7.85 rounded x plus 14,538. And then I can use that equation to predict costs at any level of activity. So for our purposes, this is actually a better method for you because all you got to know is that the intercept is F, fixed cost, and the X variable is your V, variable cost per unit. So that's the output that Excel is going to give you. It allows you to come up with the cost formula. Y equals F plus VX, the way I like to present it. And then they give you that statistic R squared, which is a measure of the goodness of fit, as I've already mentioned. So if we determine the slope is 6.02 from the regression and the intercept is 43.9567, we can then use that to come up with a cost equation. And our cost equation would be y equals 43.96, I'm rounding, plus 6.02x. And then we can use that to predict cost at any level of activity. If the output gives us an R squared of 92, that's the goodness of fit, and 92% is pretty good. So these are the actual numbers that you would get if you were to put in the details for the maintenance costs. And you could see that the answer is slightly different than what we got with our high-low method. And the least squares regression method is deemed to be a better, more accurate answer. That has nothing to do with this example here. This is just a generic output. It didn't use the maintenance numbers. I just wanted to show you what the output actually looks like. If we put in the maintenance numbers, these are the numbers that would have spit out in that output. The two methods just discussed, that's the high-low method and the sum of least squares regression method, are the way we can break up our mixed cost into its fixed and variable components. We get different estimates because the high-low method uses only 2 data points, but the sum of least squares regression uses all of the data points, and therefore it's considered more accurate. And that's it for the appendix. The one thing you want to keep in mind is the goal of doing this in the first place. So companies have all sorts of costs, and a lot of those costs are determined to be mixed. And in order to do all the CVP analysis that's related to Chapter 5, we need to be able to break up our cost into their fixed and variable components. So that's what the high-low method does, as well as regression analysis. So that's why it's presented as an appendix to this chapter. As with anything in this class, practice makes perfect. Please utilize the resources both on Canvas and Connect to get your practice in.